Good evening. It is Saturday, September 9th, 2023. Starting with the webcam on here this evening to start this video. Um, there's a lot to get to. I want to get over through the macro first, the key macro themes that I'm looking at. There's quite a few of them, and I feel like we're really coming up to a critical moment. Um, it's hard to time things exactly, but if I had to say it's within the next 2 or 3 months, it could be as soon as 2 or 3 days. Again, it's impossible to get the timing of these things exactly right, but there's a lot of things coming to a head. There's, a big intersection of forces coming to play here. And some of them are coming to play now and they're already in play. And some of them are going to be affecting the world and markets next year. Um, so we start with the key macro themes that I'm looking at. China turmoil. It's hard for an American, somebody across the world, to get a real full grasp of what's happening in China. But this Barron's article last weekend was very good. And I'm not going to go into all of it, but it's pretty clear that things are bad in China. The reopening has not gone according to plan. Uh, and the macroeconomic climate is much worse than it's been in 50 years. But there's a debt bubble, a huge debt burden that exists in China, and that's slowing growth. It's slowing lending. It's slowing activity in the economy. Uh, Clearly, this tension over Taiwan has hurt Chinese exports, and the West is transitioning away from China as much as possible. Now, clearly, China is very serious about Taiwan. We don't know exactly how this is going to play out, but um, it generally cannot be good for the economy in China, and generally not good for the world. China is very serious that Taiwan is their territory. It's not a sovereign country, and we don't know how it's going to play out. A lot of uncertainty there. But the fact is that there's a lot of uncertainty, slowing growth, poor demographics, and just tensions coming from the East, coming from Asia. Now, the second point, which I think is really important, I haven't heard many people at all talk about this, is the idea that what the Fed is doing right now and this combination of huge deficits. Uh, we are running $2 trillion deficits in the US this year. And the way we pay for that, the way the government pays for it, is by issuing debt, more debt issuance, more 12-month bills, more 5-year notes, 10-year notes, right? Um, and at the same time that the Treasury is selling all of this debt, essentially, the Fed is allowing its balance sheet to run off. So the Fed is no longer a buyer in the market, in treasuries, in MBS. The Fed is not expanding its balance sheet. It's not putting a bid into markets, but it's allowing uh, its balance sheet to run off, which is essentially pulling money out of the system. Okay, so the liquidity overall, the pool that's out there across markets, across the economy, is contracting. And quantitative easing, one of the concepts of quantitative easing is that by buying treasuries and buying, mortgages, the Fed is forcing investors to receive cash for what they would for these assets that they would normally be holding. The Fed is force feeding cash into markets, and Now, there's no longer the ability to buy the treasuries or the mortgages, the pools of mortgages that the Fed is holding on its balance sheet. And that's forcing investors to take that cash and put it elsewhere. And very often it ends up in the stock market, right? So quantitative easing is bullish for asset prices. It is a tailwind to stock prices, right? It's a tailwind to the stock market. But quantitative tightening and what's happening right now, it's the portfolio balance channel in reverse. So literally the Fed is sucking the Treasury with all of its debt issuance, and the Fed with its balance sheet contraction is sucking the pool of available capital out of markets. This is a significant tightening that's taking place. So we have a very big economic problem in China. We have the Fed sucking capital out of markets. And not to mention the Fed funds rate is 5.5%, and interest rates across the economy are at decade or multi-decade highs, right? Look at this chart of real interest rates. So this is 10-year real interest rates. We're almost at positive 2%. You can see that just as recently as 2 years ago, real interest rates were negative 1%. So this is a significant tightening. This is a major increase in the price of money. This is tightening financial conditions. This is a very clear way to show an illustration of tightening financial conditions, right? Meanwhile, US consumer debt is at all-time highs. What is it? Over $1 trillion in credit card debt throughout the US. The mortgage market is frozen. There's all these charts are available out there. You can see I already have a lot of charts up, so I didn't want to just overwhelm this and make it a 3-hour video. But all of these charts are available. They're pretty easy to find. The mortgage market is frozen. People aren't really buying new houses and taking out new mortgages. The rates are just simply too high, and the affordability is at an all-time low. Okay, the real estate market does not look very good here. Consumer is increasingly tapped out. It's clear from everything, all the Fed speakers, from Powell's speeches the last few months, there's no pivoting here in 2023. There's no rate cuts in 2023. At this point, it looks like the earliest is March of 2024. That's the earliest that I can see the first rate cut. Okay. So you can do the math on that. I think that's 7 months away. It's quite possible it may not even happen until next summer, right? So there's no pivoting going on here, right? And it remains to be uncertain uh, when and if that pivot will happen. In fact, there's a very real possibility there could still be one more rate cut in 2020, or rate hike in 2023. Rate hike. There could be one more rate hike in 2023. I don't think it's likely, but it's possible. Maybe it's a 1 in 4 chance or a 1 in 3 chance. It's possible. Um, for the Fed to pivot into a serious set of rate cuts and potentially a new round of quantitative easing, we're going to have to see a major economic calamity. Okay, and frankly, just looking at the S&P 500 at 4,500, this is nowhere near a major Fed pivot. I mean, for us to even contemplate the possibility of the Fed reigniting QE, we're going to have to be well under 4,000. Okay, and that's just for starters. Maybe even 3,500 on the S&P, right? We're not even close to that sort of situation. In fact, pull up the VIX; it's in the 13s. Um, just markets are not telling us that there's any sign of real stress out there. However, the stress is starting to form, and it's kind of showing itself gradually in a more stealth way, markets are very calm. They're unusually calm. And I hate to use sort of a trite, adage, the calm before the storm, but it really does feel like it's a calm that's an uneasy calm. It's an uneasy contraction in market volatility, while foreign exchange markets are telling us that maybe we should start to become a little concerned. Okay. We're seeing stress throughout a lot of key dollar pairs: Australian dollar, Japanese yen. And I'm going to show those charts in a bit. The credit expansion that we saw in 2020 and 2021 was unprecedented. It was an incredible easing, incredible expansionary monetary policy conditions existed in 2020 and 2021. Now, obviously, we know about the pandemic and all that, but almost every time that we've seen such an incredible expansion of credit, like we saw those 2 years, it was followed by deflationary recessions, deflation, contraction of the economy. Now, we're not in deflation yet, but we are on our way there. And looking at this chart from the Fed itself, okay, this is on Twitter, the Wall Street Journal, a reporter that follows the Fed. You can see we're down from 9% to 3% on the CPI. It's a very clear downtrend in inflation. And the frequency of price increases obviously peaked in early 2022. And actually, that was kind of a leading indicator that inflation was about to start to turn down when it started to turn down the frequency of price increases, right? And this is in a very clear downtrend. So all the evidence out there is that inflation continues to moderate, continues to come down in certain areas of the economy at a pretty rapid clip. At others, it's a bit sticky, like wages, right? But everybody seems to be focused on inflation and still continues to be concerned that the risk is a rebound in inflation, not deflation. And just from my experience as a market participant for 20 years, the thing that everybody is concerned about is not usually the thing to be concerned about. It's really not the problem that's going to arise. It's usually the other thing. And my thought is actually that with real interest rates so positive and so much tightening from the Fed in the last 18 months, those long and variable lags of monetary policy are really going to start to bite. And I think there is a risk that we could slip into deflation next year, maybe just for a very brief moment. But the fact is that if the CPI starts registering under 2%, down to 1%, or even negative, that's going to be a sign of real economic pain out there. Okay. I think, again, going back to the Fed not cutting in 2023 and not likely to cut until well into 2024, I think the Fed is so committed to not making the same error that the Fed of the 70s made, that and especially with where the stock market is at and where, home prices are, wages are, and all of these factors, the Fed is not concerned about tightening too much yet. Okay, they're just not. We're going to have to see some pain, some real pain before the Fed is like, okay, we've done too much. It's time for easing, right? And I feel like we're sort of in this gap right now. We're in the gap where inflation has come down a lot. Inflation is no longer the worry. It's no longer a real concern. It's no longer a real risk, but the Fed is going to continue to tighten the screws until they're 100% convinced that they've won the war, right? And they won't be 100% sure until well into next year, right? And so we're in this sort of air pocket where stocks are still pretty high. We've had a good 2023. Investor complacency is very high. and the cracks are forming all throughout the economy and the macro backdrop. China, Russia, Ukraine. Who knows what's going on with Saudi Arabia and Iran, right? There's all these risks out there, these cracks forming, China, Taiwan, right? And the economy in the US and even in Europe is starting to show signs of significant weakening. Um, Against the backdrop of a consumer that is full of debt with trillions of dollars of debt, and the consumer is showing real evidence of being tapped out. Okay, so we're going to go into that. Last two bullet points. Next year's a big election year in the US. I don't see how Trump doesn't win. As crazy and scary as that is to say, I don't see Biden being able to serve another term, right? So I think Trump continues to be very popular. Okay, he can definitely get half of the vote in the country. And I think people are embarrassed and tired of Biden, quite frankly, right? So unless there's an assassination or somehow he's imprisoned, between now and November 2024, I don't see how he's not president again. Can you imagine the turmoil in this country in the months and weeks, leading up to November 24, that presidential election? It can't be a positive thing, okay? And then the ESG, green energy revolution, is it's it's dead before it even really got going. Okay, they're unable to source the amount of metals that they need to reach anywhere near the forecasts that I've seen for the next decade. The mining industry is just incapable, unable, um, both from a manpower and labor standpoint. Okay, the mining labor force is aging and retiring. New college graduates are just not there. Okay, it's the least popular area for young people to enter, So this Wall Street Journal article, some really good stats here. In Australia is a mining country. The total number of mining graduates fell 63% from 2014 to 2020. So 6 years, dropped 63%. Okay. Canada, another mining country, down 10%. Okay. So you just go through all the different stats. It's down, down, down across the board. Aging labor force in the mining industry. Okay. The average age, I feel like in mining, is like 50. Okay. And half of those guys are going to be retiring here in the next 5 to 6 years. Okay. So it's just, unless we're going to have robots doing all the mining, a few years from now, it's not feasible. Even from just forget about the labor standpoint, there hasn't been enough investment. There is not investment. There is not investment. Okay. And I go to this report from Stiefel, really excellent. This was last week. Absolutely excellent. I love everything that they highlighted, all the bullet points, bang on. Okay. Just bang on. Artificially elevated cost of capital. Okay. Policy driven shift to electrification of energy generation, transmission, and usage requires a 10 mountains full of metals. Okay, and I don't even know if that's right. It's more than that. We need so many metals. So much metal has to come out of the ground to make this happen, to make it even close to feasible. And that's just simply not going to happen. I can absolutely assure you of that. The mining industry is incapable, both because they're capital starved, but also they just don't have the manpower. It's just absolutely not feasible from a manpower standpoint, right? And then, not to mention all the permitting issues, all the onerous permitting issues across North America, even Australia, even Latin America, places that you might think they're more favorable towards mining. You're more likely to get a project jammed through the permitting cycle and the government stamping it. No, there's no country in Latin America that it's easy. Not anymore. Okay, it's not easy. Canada, very difficult, very difficult. In the U.S., I mean, I don't even have to tell you. With Biden as president, it's very difficult, right? Even with Trump, it wasn't easy. Okay, this is just too many federal agencies, state level agencies, local. There's local opposition that comes about. It's not easy to permit a mine, period, and that's an understatement, right? So it's just not happening. It's not happening. Um, Perfect storm of factors, and I absolutely agree. So we're going to continue to have sort of a cost push inflation burst due to commodities. Okay, just due to the fact that we don't have the resources throughout the West, and I'm not just North America, not just South America, but also Europe. Okay, and other parts of the world. We just do not have the resources to power this green energy shift, that this fantasy dream that policymakers have come about with. Okay, so it's just not happening. So those are my key bullet points, and I really want to stress that um, the macro helps to inform me in terms of how I want to position my portfolio. It could be as simple as how much cash do I want to have as an allocation, the cash percentage of my portfolio. When I'm seeing high risks out there and little potential upside, I'm going to raise cash, right? It might be to 25%, it might be to 30%, it might even be to 35%, right? But I'm going to increase the cash allocation in my portfolio when I see storm clouds on the horizon like I do today, okay? And then it's also going to inform me as to where I'm going to put my capital, right? Am I going to overweight mining and metals, or maybe I'm going to overweight oil and energy, right? Or maybe I'm going to overweight tech, right? So the macro picture and the way I see things shaping out, and also in terms of the upside potential versus the downside risk, um, that's going to just shape my portfolio. Now, in terms of short term trading, it doesn't really matter. Short term trading is almost 100% chart focused and flow focused, and that's just tape reading. That's well beyond the scope of this video, right? But there's a big difference between long term portfolio management and shorter term trading. That could be 5 minutes, it could be 5 hours, it could be 5 days, but that's a whole different animal. Now, sometimes the two do converge in a way where, like, for example, let's say that, um, the CPI comes in pretty cool on Wednesday, and we get a risk on rally in stocks. Okay, I'm generally, due to what I'm seeing out there, I'm going to use that as an opportunity to sell, and maybe even from a shorter term trading standpoint to fade that rally, right? I might short that early morning strength if the CPI comes out the way the market wants it to be, right? Because I feel like this is a time to be selling rallies, okay? Selling rallies, not chasing rallies for sure. Okay, so let me get rid of some of these windows. So this is a tremendous 6-page piece of research from Daniel Oliver. And I skip ahead to, oh, by the way, let me get myself, okay, yeah, I'm off the camera. Okay. Um, so let's just notice that this is the Fed's balance sheet in red. And we've been doing quantitative tightening for more than a year now. Actually, it's 18 months. And this is all that's happened. Okay, so really, in the scheme of things, compared to all of this expansion, it's a blip, right? But markets are priced on the margin. And absolutely, this is beginning to weigh on asset prices. It's starting to weigh on stock prices. And as the Fed continues to do this portfolio balance channel in reverse, I think it's going to weigh even more. Okay, it's going to the impact of this is going to be felt more and more the longer this goes on. Okay, and I really like the final two paragraphs. There will be other larger accidents. The Fed will pivot. It always has. Um, and I agree. It's just not happening in the next 6 months. Probably not even the next 9 months. But it's more of a second half of 2024 thing. And I think that the fact that next year is an election year makes a Fed pivot maybe around June, getting closer to the election more likely. Okay. The last thing the Fed wants to do is being intentionally weakening the economy into an election, a major election. Okay. This is a presidential election cycle. Okay. I think the Fed has a window to hike the next 3 to 4 months. They can squeeze in one more rate hike. I think once the new year arrives, the probability of another rate hike coming from the Fed in 2024 is something like 1 or 2%. It's not likely. The most that they will do is just continue to hold rates as they are and continue quantitative tightening. But again, I think that the longer they allow the QT to happen, uh, the more of an impact, the more it's going to be felt in asset prices across markets. Okay. And he makes a really good point. He believes that the next real gold bull market will be as a result of panicking out of the dollar. Okay. And, we can talk about what could cause a panic out of the dollar. It's multifaceted. It has a lot to do with de-dollarization, uh, bipolar world. We have the East, versus the West, I guess, and probably some monetization of the debt. The Fed is forced into another QE, and the government continues to run massive deficits. Right? You get this debt monetization going on, and that could be a panic out of the dollar. Okay. But excellent piece, worth reading. Real rates, we already looked at that. Okay, so let's get into the charts. So the S&P 500, the SPY, it looks to me like we made a lower high on the day of the quote unquote Goldilocks non-farm payrolls number. I remember last September, the CPI report sent markets tumbling. It came in hot, sent markets tumbling. I have no prediction for this week's CPI, but I just wonder if something similar might happen. Okay, I feel like we're on our way down. We're starting to get into a deeper pullback now. I feel like rallies are faded. Now, that being said, my ability to time the market short term, like, you know, trying to forecast 3 or 4 days or a week of market action is not good at all, right? So I wouldn't be surprised if we got some, little rally here this week or maybe early in the week just to stop some shorts out and make it a little bit trickier to time this. But overall, I feel like we are brewing for a correction in equities, and this could very well be a lower high. It's interesting that We're sort of right here at the 50-day moving average, or at least that was the high on Friday, was the 50-day moving average. And the relative strength index on the daily time frame is right at the median line. So I feel like this next, I don't know, 3 days, 2 or 3 days will be critical, because it's going to tell us, are we going to actually get a bounce here, or are we going to really start to roll over? And I feel like a lot of charts are at a key moment, a key inflection point. QQQ, everything I said for the SPY holds true for the QQQ. Okay, I feel like we have a series now, 2 lower highs formed here on the QQQ daily chart. Now, will we get a lower low, right? That's the question. Transports. This is something I really pointed out last week. The transports are starting to really break down here. Industrials are right at support, right? So transports breaking down, breaking the August lows. Transport charts like airlines, rails look awful. Look at American Airlines, Norfolk Southern, terrible, right? So like Dow theory, we need like the industrials to confirm by breaking down along with the transports. If the industrials confirm, then we have a Dow theory sell signal playing out. But just, the transports are historically a very strong leading indicator of the economy. They are pummeled now for 2 months, absolutely pummeled, murdered. Um, that tells me the economy is really weakening. And it's a situation where you have like high prices across the economy, like airline tickets, hotel reservations, right? Rental cars, going out to eat for dinner, right? Prices are high, and they've been high for over a year now, right? The consumer is getting increasingly tapped out. Now, all we need is signs that wages are stagnating, right? And what did we get last week? We got news that Walmart is actually cutting pay for some employees. A lot of companies are announcing layoffs. Even if it's like 2% or 3% of their workforce, that's still significant. That still makes a difference, and it adds up when a lot of companies are doing the same thing, right? And so I believe this is really starting to bite. And just looking at the revisions to non-farm payrolls this entire year, they're all down, and they're totaling almost 400,000 jobs in total, right? So the picture that economists thought they had of the economy earlier in the year is absolutely not true. Uh, the employment situation is much weaker. It's much weaker. Um, Tesla. So this is also, look at the relative strength index, also right at the median line, and it's creating a little bit of a flag or pennant pattern just under the 50-day moving average. So you got flat 200-day, flat 50-day. There's no trend in this chart on the daily time frame. Like bigger picture, there's no trend. It's up, down, sideways. Tesla's gone nowhere in the last year. Okay. Uh, I think this is an important moment, and I read this chart as more likely to roll over. Okay, I would say like 60-40. The next big move, and I mean big, like 5% or more, is likely to be down in the Tesla chart. South 32, I tweeted this one, South 32, globally diversified mining company. They produce a suite of metals like copper, zinc, aluminum, nickel, you name it, they produce it, right? So this is absolutely a very cyclical company, very tuned in and affected by the strength of the global economy. Definitely correlated to China. Look at this chart. Look at this chart, right? This is an major Australian mining company. The downtrend is incredibly pronounced, and it's even started to accelerate its sell off in the last month. Okay, it was over 200 a month ago, closed Friday at 167. So look out there, guys. Like look out there. Like really flip through charts. This is not a healthy economy. This is not a strong market. Okay, Freeport McMoran. Some of my really sharp-eyed traders will immediately notice the makings of a head and shoulders pattern. Draw a neckline in here, something like this. Yeah, I'm not going to get it exactly right, but something like this. Okay, there's your neckline. Okay, so we got a little shoulder here, a little shoulder here, and a little shoulder here. It's not absolutely perfect, but it's good enough for me. Uh, that's a valid, head and shoulders top in my book. The volume even works. The volume is higher over here than it is recently. If this thing cracks under, let's say 3750, it's got downside to at least 33 and maybe even all the way down to 30, right? But the point is, if the market was really strong, if the market was about to make new 2023 highs, right, we wouldn't have these advanced topping patterns all over the place, and lots of charts that have broke down, have been battered, and a lot of other charts that are right on the cusp of breaking down, right? So Freeport McMoran, one to definitely keep your eye on. KBW, Regional Banking Index. So, financials, obviously a leading indicator, a key sector of the stock market, and very plugged into the overall economy. Man, look at this. We had that March crash. It's still right at the March crash levels. No, it's not at the May low, but this thing is barely it picked itself up off the map. Okay. This was 115 in February. It's 80. Okay. This is not a strong stock market, guys. Australian dollar, US dollar. So this is the Aussie cross with the US dollar. Well, it's at lows for the year. I think that really these key dollar pairs like the euro, the yen, the Aussie, they need to rally ASAP. They're all in pretty pronounced downtrends. The euro is testing its 50-day moving average down. What is this? 8 days in a row, right? So if there's going to be a spot on the chart where you'd say, okay, it's a buy, it would be here. 107, big round number level. If this doesn't find support here, it's telling me there's big problems coming. Obviously, yields, treasury yields, 10-year yield. Look at this. I mean, this is saying major long-term trend change. Look at the moving averages. Look at the 50-month curling up. Right. This is a major sort of paradigm shift in the yield curve that rates are higher for longer. 30-year treasury bond price. So, I mean, look at this. You've been murdered in bonds since 2020, absolutely murdered. We're at the lows, we're at the 2022 lows here on the long end of the curve, right? So this is saying that the Fed is not easing anytime soon, and the Treasury continues to increase the debt issuance to finance the deficit. Okay, so this is a huge amount of supply of Treasury paper that's weighing on prices. And now this is the chart. So these next few charts are retail charts that sort of really help to illustrate that the consumer is hurting, right? So this is LVMH. So this is high-end luxury brands, Louis Vuitton, Moet, and Hennessy, right? So these are like the aspirational brands. If you have money burning a hole in your pocket, you give this company money, you buy their products, right? This is as clear of a double top as I've ever seen. Charts got hammered the last 2 months, just like the airlines, right? Just like the transports, right? 2 months of getting murdered okay, in many key segments of the global economy. And look at the 50-day rolling over, about to cross under the 200. So we get that death cross probably in the next couple of weeks. Target, wow, obliterated. Okay, obviously they had a marketing blunder back in May, but even since then, it's made lower lows. So Target is considered to be a higher end version of Walmart, essentially. Like if you go to Target, you're willing to spend a little bit more money, get somewhat, nicer things, not have as many people in the store bothering you, right? And if you want to just save money and get the cheapest, lowest price, you go to Walmart. Look at Walmart, look at Target, look at Walmart, look at LVMH, right? So this is telling you everything you need to know about the consumer. American Express, so this is also sort of high end. If you have an American Express card, generally you have a higher income, and you're also willing to spend more on average to pay, you're paying the annual fee to use the card, right? Also getting hit in the last couple of months. Messy chart overall, definitely not a bullish chart there, right? So again, the accumulation of evidence out there across the economy, across the entire stock market, is a weakening trend. The economy is weakening. The consumer is tapped out, and a lot of companies are really starting to hurt. Okay. Um, where were we? Gold. Okay. So we've done the stock market. We're going to get to commodities, precious metals. So um, this is the monthly chart. And the points I want to make about this monthly chart is I believe that the next 2 months are critical for gold. The next two monthly closes. So September and October. Okay, I think that right now gold is cooling off and consolidating in a very healthy way. I have this line drawn on this chart for a reason. It's at 1900. That's a key downside level. That's the first area of major support here. We're at 1942.70 as of Friday's close. So we're consolidating above the blue line. That's bullish. If gold continues to consolidate here for, let's say, another 4, 5, 6 weeks between 1900 and 2000, I would say that would be incredibly bullish and increase the odds of a big upside move in the final couple of months of the year. Okay. Now, obviously, if we break down, gold breaks under 1900, closes at 1900, that changes the formula a bit. Okay. And that probably means that gold needs a longer consolidation well into next year before it makes an attempt to break out to a new all-time high. So I think we're going to get a lot of information from gold here in the next month or two. The stochastics, this is perfect. The relative strength index, the stochastics, the volume coming down a bit in recent months. All of this is textbook bullish consolidation action, right? So nothing to worry about here in gold in terms of gold in the bigger picture. The daily chart, it's just sideways. There's no real trend here. The 200-day and the 50-day are squeezing close together, right in this range, 1925 to 1950. We've made a couple of lower highs here in the last couple of months, but we've also held support just above 1900 quite nicely twice during the summer. This is sideways, right? So there's no short-term call here. It could drop back down to 1920 next week. It could jump back up to 1960, but it wouldn't be valuable information from a bigger picture perspective, right? 1900 to 1980 is just an oscillating range. We're literally right smack in the middle of that 1900 to 1980 range in gold right now. Gold versus real yield. So, this divergence, real yields going up. You can see this is the yield um, level is inverted. Real yields going up, gold staying solid, moving up and then sideways, right? So this is incredible strength and a powerful divergence. And first level thinking says, okay, gold is a short here because it needs to catch up with the move in real yields. Second level, third level thinking says, oh, somebody, big money is accumulating gold in spite of positive real yields and a 300 basis point move in the last couple of years from negative 1% to positive 2%, right? So real yields are high now, right? They have room to moderate lower. That would be bullish for gold. For sure, if real yields go further positive above 2%, if it goes to 2.5% or God forbid 3%, that's going to be a huge headwind, a huge negative for the economy. And most likely that would create the sort of event, the sort of stress, the sort of breaking point that would cause a Fed pivot. That would be rocket fuel for gold, right? So I actually am not concerned about this divergence here in the chart. In fact, I think it's more evidence of how strong the gold market actually is. Silver, all the things I said about gold, I can say for silver: oscillating range, sideways action, buy low, sell high, right? There's no resolution here. There's no resolution in either gold or silver in the near term. But bigger picture, longer term, they're very healthy consolidations. Last week, I said I really like natural gas. Well, guess what? It dropped 2 or 3 days in a row after I said that. Found support at 250. But this clearly, this bottoming process needs time. And those who probably just want to wait for the signal, wait for the breakout above $3. Because when that breakout happens, that's going to be powerful. Okay. It's very likely that will be a powerful move. Natural gas just continues to form this big rounding bottom pattern. And it wasn't trading well last week at all, but it needed to hold at 250. 250 is big support, and it did hold. Okay, so that's positive. Gold miner, as weak as can be, probably one of the worst sectors in the entire stock market in 2023, and certainly in the last couple of months, they've been incredibly weak. So we're down 6 days in a row heading into Friday. Friday, they tried to buy them in the morning. They tried to rally in the morning, and look at what happened. Sold off all afternoon and closed right near session lows. So this sector is not ready at all. I will say Beaver Creek Precious Metal Summit and Denver Gold Forum are happening the next couple of weeks. So we should get a lot of news across the sector, the gold mining sector. It'll be interesting to see how well investors, receive and digest that news. The uranium sector consolidating. So it looked like it was getting a little overheated a couple of weeks ago. Well, last week it just treaded water, basically went sideways in Cameco and Next Gen. The more I think about nuclear energy and this green energy transition, blah blah blah, that that we hear so much about, the more bullish I get on nuclear energy. I don't think there's a reason to overthink it. I think that, especially for a long-term investor who's thinking in terms of years and maybe even a decade, don't overthink the trade. Nuclear energy and uranium is the place to be for sure. And then just a couple of junior mining charts. It's hard to find good charts. It's hard to find positive setups to talk about. Things are just so bleak across the junior mining sector, the last couple of months. But two names I will throw out there, and one of them is mostly zinc, one of them is mostly copper, but both companies explore for multiple metals. Fireweed metals. This is obviously big projects in the Yukon and Northwest Territory. The Mac Pass project is primarily lead, zinc, and silver. Um, they also have a tungsten project in the Northwest Territories, right? But this is a very bullish chart. It's had a pullback to its 50-day moving average. I like the candlestick on Friday. It's quite likely that we will get news from Fireweed Metals this week, either Tuesday or Wednesday, for the Beaver Creek conference. It'll be interesting to see how investors receive that news. So this is a chart to be looking at next week, and definitely that support at 135 that also happens to line up, with the 50-day moving average is a key downside reference point. And then American Eagle Gold Corp. This is a high and tight bullish consolidation. They're exploring for copper and gold in BC. The NAC project, I'm not going to go into all of that story, but just put it very simply, they're still drilling. And I looked at their latest plan map from the drill program, and they're drilling hole number 15, which is another big step out to the south. And it looks like they're going to go even further west, with this hole. So they're being aggressive. And normally, when companies continue to drill and continue to go for step outs, very aggressive step outs to expand the map, that's not bad news. That's not a bearish sign. Okay. And Teck, big mining company, is the largest shareholder, just caught another big check for AE. Checks all the boxes for me. I'm long Fireweed, I'm long American Eagle. Think we're going to get news from both of these companies over the coming weeks, and it better be good news. So thanks a lot for your time to watch this video, and have a great weekend. Enjoy some time off the computer in nature, hopefully, and I'll see you next week.